Hey, in this video, I'm going to be talking about when are S corporation distributions taxable. And I'm going to address this in a very narrow and specific way, so I'm not going to cover all distribution scenarios as I'll talk about here. Distributions, what I mean by distributions, is a payment to shareholders from their equity in the company, not wages. And often you hear people refer to that as getting a dividend from their company, but you'll see that I don't use that phrase lightly, because the word dividend is actually a technical tax term that means a distribution from a C corporation's earnings and profits that would be taxable to the person receiving it. And so when we're talking in the context of accounting and tax, the more generic term, rather than saying I got a dividend, the more generic term to use is to say that you got a distribution from the S corporation. So that's what I'm referring to, is that payment from equity. How are those distributions treated? Well, that depends on the S corporation's history. Did the corporation ever operate as a C corporation? That's an important question here in figuring out how a distribution may be treated for tax purposes. A lot of times, an S corporation was always an S corporation. They elected to be S at corporate formation, and so they never operated as a C corporation for tax purposes, and that narrows the possibilities of how that distribution may be treated. So here I'm going to discuss corporations in that zone, corporations that always were treated as S corporations, that were never treated as C corporations. I'll do another video at some point on how you deal with S corporations that were previously C corporations, because there's a number of factors, including distributions, to consider in that scenario. But for today, in this particular video, I'm just going to stick to the kind of S corporation that was always an S, never was a C. And I'm also going to stick to talking about distributions that are made in cash, which is the most common way to make a distribution to a shareholder, is to just pay them cash out of the company accounts. It is possible to distribute non-cash property, to literally give somebody an asset or a piece of property. You might even distribute an intangible asset to a shareholder. Those are all possible transactions, but they have different kinds of tax implications to them. So for the purpose of this video, I'm not going to jump into that. I'm going to stick with kind of the run-of-the-mill, plain vanilla. You make a cash distribution from the equity of your S corporation, a corporation that was always an S corporation. What does that mean? Well, as a reminder, S corporations are generally not subject to federal income tax. It's the owners that are subject, the shareholders that are subject to income tax on that income. The S corporation will file a tax return, but it's an informational return. It determines what the corporate income is, and then it reports that to the shareholders, who include that on their individual tax returns. The exceptions that would cause a S corporation to pay a federal income tax revolve again around scenarios where that S corporation previously operated as a C corporation. So that's something I'll kind of get into in some other video. The S corporation is going to report its profits to shareholders. As I said earlier, they do that. The mechanism that they currently do that through on tax returns is called a Schedule K-1, and then the shareholders take those K-1s and they report that income on their personal return. We refer to that as flow-through taxation. And if you've ever been a partner in a partnership or familiar with partnership taxation, you'll recognize that it's the same process for partnerships, that partnerships also have flow-through taxation. So S corporations, like partnerships, have flow-through taxation. Analyzing distributions, the topic here, depends on a shareholder's basis in their stock of the corporation. Now, if your S corporation happens to be legally, for state purposes, an LLC that elected to be treated as a corporation, an S corporation, you have to basically tell a tax fiction. You have to pretend as if your owners, your LLC members, don't just have membership units in an LLC, but in fact have shares of stock in this fictional corporation, because when you elected S, that was the tax fiction you all agreed to stick by for the purpose of determining the federal tax results. So the shareholders' tax basis in their share, basically what that means is their after-tax investment in the S corporation. And if you think about where that after-tax investment comes from, It's money that they put into the S corporation, after tax dollars that they earned or received somewhere else in their life, and then they put into the corporation. That creates shareholder tax basis in their stock. It is an amount that the shareholder should be able to draw out without paying tax, because it's being established, that stock basis is being established with these after-tax dollars. And aside from directly putting money in, the other way that the shareholder gets basis is the corporation earns money, which the shareholder is taxed on, but the shareholder is not necessarily, or excuse me, the corporation is not necessarily required to distribute that money. So that money that the shareholder has already paid tax on, that the corporation is holding, is retained earnings, retained profits that the shareholder has paid tax on, and that would increase their basis in stock, because their basis in stock is a measurement of their after-tax investment in the corporation. So among other things, as what I'm getting at is that that basis number goes up or down with the company's income or loss. So just like if the company earns money that the shareholder is taxed on, the stock basis goes up. If the company loses money or has losses that flow through and the shareholder takes, which ultimately should lead to the shareholder at some point getting a deduction for those losses, that reduces their basis in stock. Now, a complete discussion of stock basis is beyond what I want to get into in this video to keep it short enough for you all. So I'll talk about stock basis in some other video with more details. But the reason that I got into talking about stock basis is back to our main topic. What is the tax treatment of a distribution from equity? Well, distributions are measured against the shareholder's stock basis. So if the owner has basis, then the distribution shouldn't be taxable. The distribution, basically, you have basis, it's like a bucket, right? And you put all this after-tax dollars in the bucket. If you take money out of that bucket, it's not taxable because it shouldn't be taxed twice. So if you already paid tax on it, you've got dollars in that bucket, you should be able to take it out without paying tax again. The distribution is going to reduce the stock basis, because if you follow my bucket analogy, if you've got this bucket and you've stuck a bunch of after-tax dollars in it and then you take money out of it, that's your distribution. We're saying that's not taxable because you had money to take out, right? Okay, but of course that reduces what's in the bucket, so a distribution is going to reduce that stock basis. But once you've made these once you've exhausted this bucket, once there's nothing in the bucket, you can't go below the bottom of the bucket. You can't go to zero. You can't go below zero. So you either have stock basis to distribute from, or you just don't have any stock basis to distribute from. Stock basis cannot be less than zero. So if a distribution exceeds the basis, like if you go to take a distribution and there's nothing in your bucket, you didn't put any after-tax dollars in there, or you've already taken them all out, and you haven't earned any profits since you've taken them all out, profits that were taxable. So there's no basis in there, right? So if there is no basis in the bucket, then if you take a distribution, it's taxable. Now think about the underlying economics of this, right? So these are very technical tax ways of thinking about this result, but it's a reflection of the underlying economics, which comes down to this main point, which is, if as an owner investor, you've already pulled out every dollar you ever put into this business, and you've already pulled out all the profits the business ever earned, where's the cash coming from that you're pulling? Well, it's either coming from what other investors put into the company, or it's coming from debt. It's coming from creditors who loan money to the company, and you're pulling that cash out for yourself. And that's essentially frames the tax policy here, right? Because ultimately, if your bucket has no tax basis in it, if you have no after-tax dollars invested in this company at the time that you dip in and pull out a distribution, that distribution becomes taxable. That distribution that exceeds your basis in stock is treated as a capital gain for the owner on their personal tax return. Okay, well, I'm going to do more videos like this on S corporation operations in between gardening here, so I will see you soon. Take care. Goodbye now.